Why most people confuse speculation with investment. There has always been confusion in the financial world between speculation and investment. This confusion is not accidental, nor is it new. Benjamin Graham observed it throughout his lifetime, long before the rise of modern trading platforms, social media, or 24-hour financial news. He believed that this misunderstanding was one of the greatest dangers facing individual investors, because it led them to take risks they did not fully understand while believing they were acting resp. On SIBOY. At its core, the confusion exists because speculation and investment often look similar on the surface. Both involve buying securities, both involve the hope of profit, both involve exposure to market prices, yet beneath this surface similarity lies a fundamental difference in purpose, method, and risk. Graham argued that most people believe they are investing when, in reality, they are speculating. This misunderstanding begins with human psychology. Human beings are naturally attracted to speed. We prefer outcomes that arrive quickly. We seek feedback, validation, and confirmation in most areas of life. Quick feedback helps us learn and adapt. In markets, however, quick feedback often misleads. Speculation thrives in environments where speed is rewarded and patience is punished. The modern market environment amplifies this tendency. Prices update constantly, news arrives continuously, opinions change by the minute. Every movement appears meaningful. Every fluctuation invites interpretation. In such an environment, speculation feels intelligent. Investors who speculate often feel informed, active, and engaged. They analyze charts, follow news, track trends, and react to developments. This activity creates the impression of control. It feels as though decisions are being made based on insight rather than impulse. Benjamin Graham rejected this impression completely. He believed that activity is not evidence of intelligence and that confidence is not evidence of understanding. In fact, he observed that the most confident market participants were often the most speculative. To Graham, speculation was not defined by risk alone, it was defined by intent. Speculation, in his view, was an attempt to profit from short-term price movements by predicting what other market participants would do next. Investment, by contrast, was an attempt to purchase a portion of a business at a price that offered safety and a reasonable return over time. This distinction is subtle, but critical. Most people confuse speculation with investment because markets reward speculation temporarily. Short-term gains create excitement. Rapid profits reinforce behavior. Early success convinces participants that their approach is sound. Graham observed that speculation often succeeds early and fails later, while investment often appears to fail early and succeeds later. This reversal of feedback creates powerful psychological traps. When speculation works quickly, it feels validated. When investment works slowly, it feels uncertain. Human nature prefers the former. Another reason speculation and investment are confused is language. Financial media often uses the word investing to describe all market activity. Trading, forecasting, momentum chasing, and even gambling-like behavior are frequently labeled as investing. This language blurs distinctions and normalizes speculative behavior. Graham was deeply concerned about this normalization. He believed that investors must understand clearly which activity they are engaging in. Speculation, when acknowledged as such, can be managed. Speculation disguised as investment is dangerous. Why is this so important? Because speculation and investment require completely different skills, mindsets, and expectations. Speculation depends on prediction. It requires anticipating short-term price movements. This means predicting how other market participants will react to information, emotion, and events. It is inherently competitive and uncertain. Investment depends on analysis. It requires evaluating businesses, assets, earnings, and financial strength. It does not require predicting short-term market behavior. It requires patience and discipline. Graham believed that most individual investors were poorly equipped to speculate, yet were constantly encouraged to do so. The appeal of speculation is easy to understand. It promises fast results. It offers excitement. It provides constant engagement. In rising markets, it rewards boldness. It makes participants feel skilled and informed. Investment, by contrast, feels dull. It requires reading financial statements, evaluating balance sheets, and tolerating long periods where nothing seems to happen. It offers little excitement and delayed gratification. In a culture that values speed and action, speculation feels superior. Graham understood this cultural pressure. He did not blame investors for succumbing to it. He blamed the environment that encouraged speculation while labeling it as investment. He also understood that speculation is not inherently evil, but it becomes dangerous when participants do not recognize it as speculation. Speculators often believe they are investors. They tell themselves they are buying good companies or strong stocks, even when their decisions are driven entirely by price movement or short-term news. They hold positions briefly, exit quickly, and move on constantly, all while believing they are investing. Graham believed this self-deception was one of the greatest threats to financial security. He defined an investment operation very carefully. According to Graham, an investment operation is one that, after thorough analysis, promises safety of principal and an adequate return. Operations that do not meet these criteria are speculative. This definition is uncompromising. It does not allow speculation to hide behind optimism. It does not allow hope to replace analysis. It does not allow short-term success to redefine long-term risk. Most market activity fails this test. Speculation often ignores safety of principle. It accepts high risk in exchange for the possibility of quick gain. It often assumes that positions can be exited easily if conditions change. Graham observed that this assumption frequently failed during periods of market stress. Speculation also rarely defines what an adequate return is. It focuses on maximum return rather than reasonable return. This focus increases risk exposure and emotional volatility. Investment, by contrast, defines return expectations conservatively. It accepts modest gains achieved consistently over long periods. It prioritizes survival over excitement. Another reason people confuse speculation with investment is that speculation often uses analytical tools. Charts, indicators, and models create the impression of rigor. Numbers give the appearance of precision. Graham warned that precision is not the same as accuracy, and that complexity is not the same as understanding. Speculative tools often measure market behavior rather than business reality. They analyze price movements instead of intrinsic value. They attempt to infer future behavior from past patterns. Graham did not deny that patterns exist. He denied that they could be exploited consistently without exposing the investor to significant risk. Investment analysis, in Graham's view, focused on what could be known with reasonable confidence: assets, earnings, liabilities, and financial structure. These elements changed slowly and could be evaluated objectively. Speculation focused on what could not be known: short-term sentiment, future reactions, and timing. Time horizon is another key differentiator. Speculators operate on short timelines. Their success depends on being right quickly. They are sensitive to immediate outcomes. Losses demand rapid response. Gains demand rapid capture. Investors operate on long timelines. Their success depends on being approximately right over time. Temporary mispricing does not threaten their strategy. Time absorbs uncertainty. Graham believed that time exposes the difference between speculation and investment over long periods. Speculative strategies tend to fail because prediction errors accumulate. Investment strategies tend to succeed because value asserts itself. This does not mean every investment succeeds. It means that the approach itself is aligned with reality rather than emotion. Another reason speculation is attractive is that it creates stories. Stories are compelling. They explain why prices should move. They simplify complexity. They provide narrative satisfaction. Investment analysis rarely produces exciting stories. It produces numbers, assumptions, and probabilities. It is uncomfortable because it does not offer certainty. Graham understood the power of stories and warned investors against them. He believed that stories often replaced analysis during speculative episodes. When investors buy based on stories, they are speculating even if the story sounds reasonable. Speculation also offers social reinforcement. Trends create communities. Shared excitement builds confidence. When many people agree, doubt diminishes. The investment is often lonely. Long-term investors may appear out of step. They may avoid popular assets. they may endure periods of underperformance. They may face criticism for being conservative. Graham believed that social pressure is one of the strongest forces pushing investors towards speculation. Speculators often measure success relative to others. They chase what is popular. They fear missing out. This behavior shortens time horizons and increases risk. Investors measure success relative to objectives. They prioritize capital preservation. They are less influenced by comparison. Another subtle reason speculation and investment are confused is that speculation sometimes succeeds spectacularly. These successes receive attention. They dominate conversation. They inspire imitation. Failures receive less attention. They are quietly absorbed or forgotten. This creates a distorted perception of risk. Graham warned that investors should not judge strategies by isolated successes. They should judge them by long-term survivability. Speculation often fails this test. He believed that most fortunes lost in markets were lost through speculation conducted under the belief that it was investment. This belief led investors to take risks they did not understand, hold positions they could not justify, and react emotionally to outcomes they could not control. By contrast, investors who clearly understood the difference between speculation and investment were better equipped to manage risk, endure volatility, and achieve satisfactory results. Clarity was Graham's goal. He did not ask investors to eliminate speculation entirely. He asked them to recognize it honestly and separate it from their investment capital. He believed that speculation should be limited, controlled, and treated as entertainment rather than strategy. Investment capital, by contrast, should be protected, analyzed, and deployed with patience. This separation was essential. Benjamin Graham's definition of investment. Benjamin Graham was unusually precise with words. He believed that vague language led to vague thinking, and vague thinking led to financial harm. Nowhere was this more evident than in his definition of investment. Graham did not describe investment loosely or casually. He defined it carefully, deliberately, and with consequences. According to Graham, an investment operation is one that, after thorough analysis, promises safety of principal and an adequate return. Operations not meeting these requirements are speculative. This definition may sound simple, but it is uncompromising. It leaves very little room for interpretation. It demands discipline where most investors prefer flexibility. It demands patience where most investors seek speed. Graham understood that many people would resist this definition, not because it was incorrect, but because it was restrictive. The first requirement Graham insisted upon was thorough analysis. Analysis, in Graham's framework, did not mean prediction. It did not mean forecasting market movements or anticipating short-term price changes. It meant understanding what was being purchased. It meant examining financial statements, balance sheets, income stability, asset quality, debt levels, and earning power. Analysis was about grounding decisions in reality rather than expectation. Speculators often claim to analyze markets, but Graham observed that their analysis focused on price behavior rather than business substance. They studied charts instead of cash flows. They examined momentum instead of margins. They focused on what others might do rather than what the business could sustain. Graham believed this was not analysis, it was interpretation of crowd behavior. Investment analysis, by contrast, focused on facts that changed slowly and could be verified. It did not require speed. It required care. The second requirement Graham insisted upon was safety of principal. This was perhaps the most controversial aspect of his definition. Many investors associate safety with low returns. Graham rejected this association. To him, safety did not mean absence of risk. It meant protection against permanent loss. Safety of principal was not achieved through optimism or confidence. It was achieved through structure. Diversification reduced exposure to individual failures. Conservative valuation reduced downside risk. Strong balance sheets reduced vulnerability. Graham believed that any operation that could not reasonably protect capital under adverse conditions was speculative, regardless of how attractive it appeared. Speculators often assume they can exit positions before losses become permanent. Graham observed that this assumption frequently failed. During periods of panic or market stress, liquidity disappeared. Prices collapsed faster than investors could respond. Safety that depended on timing was not safety at all. True safety was built into the purchase itself. The third requirement Graham emphasized was an adequate return. He did not define adequacy in terms of maximizing profit, he defined it in terms of reasonableness. An adequate return was one that compensated the investor for risk without requiring extraordinary outcomes. Speculators pursue exceptional returns, investors pursue satisfactory returns. This distinction is subtle but critical. Pursuit of exceptional returns often leads investors to accept exceptional risk. Pursuit of adequate returns allows investors to remain conservative and disciplined. Graham believed that the desire for exceptional outcomes was one of the primary drivers of speculation. Another important element of Graham's definition is what? It excludes hope as a strategy. It excludes prediction as a requirement. It excludes short-term success as validation. An operation could produce profits and still be speculative if it lacked analysis, safety, or reasonable expectations. This was difficult for many investors to accept. Graham observed that people often judge decisions by outcomes rather than process. If a speculative trade succeeded, it was praised. If an investment underperformed temporarily, it was criticized. Graham believed this approach was backward. Correct process mattered more than immediate outcome. Time would eventually reveal which approach was sound. Another reason Graham's definition was so important is that it forced investors to confront uncomfortable questions. Why am I buying this security? What protects my capital if I am wrong? What return am I realistically expecting? Speculators often avoid these questions. They rely on confidence, narratives, or momentum. Investors must answer them honestly. Graham believed that most market participants did not want to answer these questions because the answers limited their behavior. Limitation is uncomfortable. Speculation thrives on flexibility. Investors want the freedom to act quickly, to change views, to chase opportunity. Graham's definition imposed discipline. Discipline restricts behavior, but it also protects. Graham did not believe that markets were evil or malicious. He believed they were indifferent. Markets offered prices, not protection. It was the investor's responsibility to build safety into decisions. Speculation outsourced safety to timing and luck. Investment built safety into structure. Another key difference Graham emphasized was time horizon. Investment assumed long holding periods. It accepted that value recognition might take years. It required patience. Speculation depended on near-term movement. It required frequent reassessment. It demanded responsiveness. Graham believed that shortening time horizons increased risk exponentially. The shorter the horizon, the more outcomes depended on emotion rather than fundamentals. Time was the ally of the investor and the enemy of the speculator. Graham also observed that speculation often masqueraded as investment during favorable conditions. Rising markets made speculative behavior appear disciplined. Gains arrived quickly. Confidence grew. This illusion collapsed when conditions changed. Graham believed that true investment should function under both favorable and unfavorable conditions. It should not rely on optimism or momentum. This is why he insisted on safety of principle as a core requirement. Another important aspect of Graham's definition is that it applies universally. It does not depend on asset class, market condition, or economic environment. Whether buying stocks, bonds, or other securities, the same criteria applied. This universality appealed to Graham because it simplified decision-making. Instead of asking whether something was fashionable or exciting, investors asked whether it met the criteria of investment. If it did not, it was speculation. This clarity reduced confusion. Graham also recognized that speculation was unavoidable in markets. Some participants would always speculate. Prices would always fluctuate. Trends would always form. His concern was not eliminating speculation from markets, but preventing investors from confusing it with investment. When speculation was acknowledged honestly, it could be limited and controlled. When it was disguised as investment, it infiltrated portfolios quietly and increased risk without warning. Graham believed that investors should treat speculation like fire, useful in small, controlled amounts, dangerous when allowed to spread. He often suggested that if investors wished to speculate, they should do so consciously and with limited capital, separate from their investment funds. This separation protected long-term security. Investment capital, by contrast, should be treated conservatively. It should not depend on prediction. It should not chase trends. It should not seek excitement. This separation required honesty. Many investors resist honesty because it exposes uncomfortable truths. They want to believe they are investors even when their behavior is speculative, Graham insisted. That behavior, not intention, defined activity. What matters is not what investors say they are doing, but what they are actually doing. Are they analyzing businesses or watching prices? Are they protecting capital or chasing returns? Are they relying on time or timing? These questions reveal the truth. Graham believed that once investors clearly understood the difference between speculation and investment, many would choose investment, not because it was exciting, but because it was safer. Safety was Graham's priority. The psychology of speculation. Benjamin Graham understood something that many market participants never fully grasp. Speculation is not driven primarily by logic, it is driven by psychology. It appeals to deep human instincts that evolved long before financial markets existed and that are poorly suited to the environment of modern investing. Speculation feels natural, investment feels unnatural. This difference alone explains why speculation is so widespread and why investment discipline is so rare. Human beings are wired to respond to movement. When something changes quickly, our attention is drawn to it. When something remains static, we ignore it. Markets exploit this instinct perfectly. Prices move constantly, numbers flash, colors change, each movement feels like information. Speculators interpret movement as meaning. Benjamin Graham believed this was one of the most dangerous illusions in finance. Movement does not necessarily indicate value, it indicates activity. Yet the brain treats activity as significance. Speculation feeds on this misinterpretation. Another powerful psychological force behind speculation is the desire for prediction. Humans want to know what will happen next. Uncertainty creates discomfort. Prediction offers relief. Even inaccurate prediction feels better than admitting uncertainty. Speculators seek this relief constantly. They analyze charts, follow forecasts, and listen to experts not because these tools guarantee accuracy, but because they reduce anxiety temporarily. Graham observed that the emotional comfort of prediction often matters more to speculators than its accuracy. This comfort is dangerous because it encourages overconfidence. When predictions succeed occasionally, as they inevitably do, confidence grows disproportionately. The speculator attributes success to skill rather than chance. This attribution error reinforces speculative behavior. Investment, by contrast, does not promise predictive comfort. It requires acceptance of uncertainty. It acknowledges that timing cannot be controlled. This acknowledgement feels unsettling. Speculation feels empowering. Investment feels humbling. Graham believed that most people preferred empowerment to humility, even when empowerment was illusory. Another psychological driver of speculation is immediate feedback. Speculative decisions produce quick results. Prices move shortly after trades are made. Gains or losses appear almost instantly. This feedback loop is addictive. Gains produce excitement and validation. Losses produce urgency and engagement. Either outcome keeps the speculator emotionally involved. Investment offers delayed feedback. Decisions may take years to validate. During this time, doubt accumulates. The absence of feedback feels like stagnation. Speculators confuse feedback with correctness. Investors learn to live without it. Graham believed that this difference explained why speculation dominates public attention while investment operates quietly in the background. Speculation also benefits from social reinforcement. Trends attract communities, shared beliefs amplify confidence. When many people agree, doubt diminishes. During speculative episodes, skepticism is ridiculed, caution is dismissed as fear. Those who resist participation feel isolated. Graham recognized this dynamic as extremely dangerous. Social reinforcement creates groupthink. Groupthink suppresses independent judgment. Investment often requires standing apart. Long-term investors may appear slow, conservative, or out of touch during speculative booms. They may underperform temporarily. They may face criticism. Speculators rarely face criticism while prices rise. This imbalance distorts perception. It makes speculation appear superior during favorable conditions. It hides risk until conditions reverse. Graham observed that speculation borrows confidence from crowds, while investment relies on individual judgment. Another psychological factor behind speculation is fear of missing out. When prices rise rapidly, non-participants feel excluded. They imagine opportunities slipping away. This fear shortens time horizons and overrides caution. Speculators act to relieve this fear. They enter positions without analysis. They justify decisions retroactively. They tell themselves stories to support action. Investment resists this impulse. It accepts missed opportunities. It prioritizes safety over participation. Graham believed that missing opportunities was less harmful than participating in dangerous ones. Speculation also thrives on simplification. Complex realities are reduced to narratives. Markets become stories about technology, growth, disruption, or recovery. These stories feel intuitive. They provide clarity. Investment analysis often complicates rather than simplifies. It reveals uncertainty. It exposes limitations. It forces investors to confront probabilities rather than promises. Speculators prefer clarity, even false clarity, to complexity. Graham warned that narratives are not substitutes for analysis. They may explain price movement, but they do not justify value. Another powerful psychological driver of speculation is ego. Speculation offers the possibility of being right publicly. Successful speculators gain attention. Their confidence is celebrated. Their predictions are praised. Investment success is quieter. It unfolds slowly. It attracts little recognition. Graham believed that ego pushed many investors towards speculation because speculation offered visibility. Investment offered security, not applause. Speculation also allows investors to attribute failures to external factors. Markets were irrational. News was unexpected. Conditions changed. Responsibility is diffused. Investment requires accountability. Decisions are justified through analysis. Mistakes are examined. Responsibility is internal. This accountability is uncomfortable. Graham believed that most people preferred environments where responsibility could be avoided. Speculation also thrives on short memory. Speculative losses are often forgotten or minimized. Speculative gains are remembered vividly. This selective memory distorts perception of success. Investment performance, measured over long periods, is harder to distort. Results accumulate. Reality becomes visible. Time exposes truth. Another psychological danger of speculation is that it changes how investors interpret information. News is no longer evaluated for long-term impact. It is evaluated for immediate price effect. Speculators ask, how will the market react? Investors ask, how does this affect value? These questions lead to very different decisions. Speculation encourages constant reinterpretation. Each new piece of information triggers reassessment. Positions are adjusted frequently. Conviction remains shallow. Investment encourages stability. Information is evaluated carefully. Only meaningful changes prompt action. Graham believed that frequent decision-making increases error, especially when driven by emotion. Speculation also distorts risk perception. Gains feel earned. Losses feel temporary. Confidence increases. Risk exposure grows. This dynamic continues until conditions change abruptly. Graham observed that speculative confidence peaks just before failure. Investment confidence grows slowly and is often strongest during periods of pessimism. Another psychological trap of speculation is delusion of learning. Speculators believe that constant activity improves skill. They trade more, analyze more, react more. They assume experience equals competence. Graham rejected this assumption. Experience without reflection reinforces mistakes. Activity without structure produces noise. Investment learning is slower but deeper. It focuses on understanding businesses, cycles, and human behavior. It benefits from time. Speculation also encourages emotional attachment to positions. When investors speculate, they often identify with their predictions. Being wrong feels personal. Losses trigger defensiveness. Investment encourages detachment. Positions are held based on value, not identity. Being wrong prompts reassessment rather than reaction. Graham believed that emotional attachment was one of the greatest dangers in markets. Speculation feeds attachment. Investment limits it. Another reason speculation is so compelling is that it promises control. Short-term decisions feel manageable. Outcomes appear influenced by action. Investment requires surrendering control to time. This surrender feels uncomfortable. Graham believed that accepting lack of control was essential to intelligent investing. Speculation also benefits from optimism bias. Investors believe they will exit before losses escalate. They believe they will recognize danger in time. History repeatedly disproves this belief. During market stress, liquidity vanishes, prices gap down, decisions become difficult. Emotional pressure overwhelms rational planning. Graham warned that strategies dependent on perfect timing are inherently fragile. Investment does not require perfect timing. It requires adequate pricing and patience. Speculation also distorts time perception. Short-term results feel significant. Long-term consequences feel distant. This distortion encourages risk-taking. Investment corrects this distortion by extending time horizons. Graham believed that time was the ultimate test of any approach. Speculation fails this test because errors compound. Investment passes because value asserts itself. The psychology of speculation explains why so many intelligent people fail in markets. Intelligence does not protect against emotional bias. In some cases, it amplifies it by providing justification for impulsive behavior. Graham believed that understanding these psychological forces was essential for resisting speculation. Investors who believed they were immune were often the most vulnerable. Awareness precedes discipline. Short-term market prediction, a dangerous game. Benjamin Graham was deeply skeptical of short-term market prediction, not because he believed markets were random in every sense, but because he believed that the forces driving short-term price movement were too complex, emotional, and unstable to be forecasted reliably. He viewed prediction as the intellectual foundation of speculation and therefore as one of its greatest dangers. To speculate successfully, an investor must be right twice. First, they must correctly anticipate how the market will react. Second, they must act at exactly the right moment. Graham believed that even if the first condition was met occasionally, the second would fail often enough to destroy long-term results. Short-term prediction creates the illusion of mastery. Markets constantly invite prediction. Prices move, news breaks, economic data is released, experts offer opinions. Each event suggests that the future can be anticipated if one is attentive enough. Graham observed that this constant invitation lured investors into believing that markets were puzzles to be solved rather than systems to be endured. The problem is not that prediction never works. The problem is that it does not work consistently enough to justify the risk it requires. Speculators often point to successful predictions as evidence of skill. Graham pointed to the long-term record. Over extended periods, prediction-based strategies tend to fail because errors accumulate faster than successes. One incorrect prediction can erase many correct ones. Short-term prediction also depends heavily on interpreting other people's emotions. Price movement reflects fear, optimism, surprise, and expectation. Predicting these emotions requires not only understanding information, but understanding how millions of individuals will react to it. Graham believed this task was impossible to perform reliably. Even when information is clear, reaction is unpredictable. Good news may be ignored, bad news may be overreacted to, expectations may already be priced in. Outcomes rarely align with forecasts. Speculation assumes predictability where none exists. Another danger of short-term prediction is that it encourages overreaction. When investors believe that every piece of information matters immediately, they respond too quickly. Decisions are made under pressure. Emotional bias overrides analysis. Graham believed that speed was not an advantage in investing. It was often a liability. Investment decisions benefit from delay. Delay allows emotion to subside. Delay allows information to be contextualized. Delay improves judgment. Prediction eliminates delay. Speculation also relies heavily on historical patterns. Charts and indicators attempt to extrapolate the future from the past. Graham warned that markets change, participants change, conditions change. Patterns that appear stable often break unexpectedly. Reliance on patterns creates false confidence. Graham did not deny that markets exhibit trends. He denied that trends could be exploited consistently without exposing the investor to significant risk. Trends attract participation. Participation increases crowd behavior. Crowd behavior amplifies reversals. Speculators often enter trends late and exit poorly. Another weakness of prediction-based strategies is confirmation bias, once a prediction is made. Investors seek information that supports it. Contradictory evidence is ignored or minimized. This bias intensifies emotional attachment to positions. Investment analysis, by contrast, encourages skepticism. Assumptions are tested, risks are examined, decisions are not defended emotionally. Prediction also distorts risk assessment. When investors believe they understand what will happen next, they underestimate downside. They assume they will react in time. They believe exits will be available. History shows otherwise. During periods of stress, markets move rapidly, liquidity dries up, prices gap, exit plans fail, predictions become irrelevant. Graham believed that strategies dependent on timely exits were inherently speculative. Investment did not require perfect exits, it required reasonable entry prices and time. Short-term prediction also creates a false sense of urgency. Investors feel compelled to act quickly before conditions change. This urgency reduces deliberation. It increases error. Graham observed that many poor decisions were made not because information was lacking, but because investors felt rushed. Investment removes urgency by extending time horizons. Prediction also invites comparison. Investors measure their forecasts against others. They seek validation. They fear being wrong publicly. This social dimension increases pressure. Graham believed that investing should be private and deliberate, not performative. Another problem with prediction is that it rewards luck in the short term. Successful predictions may result from chance rather than insight. When luck is mistaken for skill, confidence increases, risk exposure grows. Eventually, luck reverses. Graham believed that markets punish overconfidence mercilessly. Investment strategies grounded in fundamentals do not require frequent correctness. They tolerate error, they absorb uncertainty. Prediction-based strategies do not. Prediction also shifts focus away from what can be known. Instead of analyzing balance sheets, earnings stability, and asset values, speculators focus on narratives, expectations, and sentiment. Graham believed this shift weakened decision quality. He encouraged investors to ask simple questions. What am I buying? What is it worth? What protects me if I am wrong? Prediction rarely answers these questions. Another subtle danger of prediction is that it shortens learning cycles. Investors receive feedback quickly, but the feedback is noisy. They learn the wrong lessons. They attribute outcomes to skill rather than chance. Investment learning is slower but more accurate. Over long periods, patterns emerge. Reality asserts itself. Time teaches truth. Graham also believed that prediction encourages excessive trading. Frequent decisions increase transaction costs, taxes, and emotional fatigue. Each trade introduces risk. Investment minimizes trading. It reduces friction. It preserves compounding. Short-term prediction is also vulnerable to regime change. What works in one environment fails in another. Investors often realize this too late. Investment grounded in value adapts more naturally. Businesses evolve, assets endure, time allows adjustment. Graham did not claim that markets were always rational. He claimed that markets were eventually rational. Short-term prediction ignored this eventuality. Investment relied on it. Speculation seeks to profit from the market's irrationality. Investment seeks protection from it. This distinction is fundamental. Graham believed that investors who focused on prediction were playing a dangerous game not because they were foolish, but because the game itself was stacked against them. The market does not reward prediction consistently. It rewards discipline occasionally and punishes impatience frequently. Investing based on fundamentals. Benjamin Graham believed that investing begins not with stock prices, but with businesses. This belief seems obvious, yet it is often ignored. Many market participants spend far more time watching prices than understanding what those prices represent. Graham viewed this as the defining difference between speculation and investment. Speculators focus on what stocks do. Investors focus on what businesses are. A stock is not merely a symbol on a screen. It represents ownership in a real enterprise, an enterprise with assets, liabilities, revenues, expenses, and long-term prospects. Graham insisted that investors must never forget this distinction. When they do, stocks become abstract tokens, and speculation replaces analysis. Fundamental analysis, in Graham's framework, is the disciplined study of business reality. It asks questions that price movement cannot answer. What does this company own? What does it owe? How stable are its earnings? How resilient is its business model? How does it perform across economic cycles? These questions require patience. They do not yield instant gratification. They are often boring. Graham believed that boredom was a sign that analysis was being done correctly. Speculators avoid boredom. Investors accept it. One of Graham's central insights was that price and value are not the same thing. Price is what the market offers at a given moment. Value is what a business is worth based on its fundamentals. The difference between the two creates opportunity. Speculation ignores this difference. It assumes price movement reflects value change. Investment relies on the opposite assumption that prices often diverge from value, sometimes dramatically. Graham believed that markets were emotional in the short term and rational in the long term. Fundamental analysis aligned investors with long-term rationality. Another key aspect of fundamentals is earning power. Graham did not focus solely on recent earnings. He examined earnings across long periods, including downturns. He believed that stable earning power was more important than rapid growth. Speculators often chase growth stories. Investors examine sustainability. Growth can disappear quickly. Stability endures. Graham also emphasized the importance of balance sheets. Assets provided protection, did introduce risk. Strong balance sheets reduced the chance of permanent loss. Speculators rarely examine balance sheets. They assume liquidity and timing will protect them. Graham observed that during crises, these assumptions failed. Investment built protection into structure. Another fundamental Graham stressed was valuation. No business was attractive at any price. Even the best company could be a poor investment if purchased too expensively. Valuation determined risk.